Something just happened in silver that most people won't understand until it's too late. And if you're holding silver right now, if you're stacking physical, if you've got leveraged positions open, or if you're even just watching this market because you know something felt off, you need to stay with me for the next few minutes. Because what you're seeing isn't what you think it is. In less than a week, we watched spot silver crater from about $121 down to the low 80s, with an intraday flush that hit near $71 before buyers could even process what was happening. That's more than a 30% drawdown in days, not months, days. And here's what almost nobody is talking about. The real trigger wasn't fear. It wasn't headlines. It wasn't some fundamental shift in supply or demand. It was mechanical. The CME raised silver margin requirements by roughly 36%, and as global markets reopened, forced selling kicked in hard. Both exchange data and clearing reports confirmed it. If you're watching this right now, you're ahead of most people who are still trying to figure out why their charts look broken. Your job right now is to understand what actually happened and how to recognize this pattern before it traps you next time. Before I explain exactly what caused this move, let me slow down and teach you something that most people never really internalize. Markets don't always move because opinions change. Sometimes they move because the rules of participation change. And that's a completely different animal. Think of leverage like you're driving on a highway with cruise control. Everything feels smooth. You're comfortable. You're making progress. Then suddenly the speed limit drops by 30 miles per hour. You didn't change how you're driving. Your intentions didn't change, but now you're in violation. That's what a margin hike does. It doesn't care if you're bullish or bearish. It doesn't care about your conviction or your analysis or how much research you did. It just changes how much capital you're allowed to use, instantly. And when that happens, price becomes secondary. Liquidity becomes everything. If you understand that distinction, you stop being surprised by crashes that don't make sense on the surface. You stop asking why fundamentals don't matter in that moment. Because they don't. Not yet. What matters is who can hold and who has to sell. Let me say that again. What matters is who can hold and who has to sell. When you're watching a market move and you're thinking, this doesn't make sense based on value or based on news, ask yourself this instead. Who just got forced out? Because odds are, that's your answer. And when you start thinking that way, you see these moves coming from a mile away. You recognize the setup. You know what forced liquidation looks like before it even starts. That's the skill I want you to walk away with today. Not a prediction, not a hot take. A framework. Now here's what's actually happening under the hood. Let me break down the sequence so you can see the mechanics clearly. First, silver had become crowded. Lots of leverage, lots of momentum, lots of late positioning where traders were chasing the same move higher. That's not inherently bad, but it creates fragility. Then the CME steps in and raises margin requirements by about 36%. Now think about what that means in real terms. Every leveraged trader suddenly needs more cash to hold the exact same position. Not tomorrow, not next week, now. So when Asia opens on Monday morning, and then Europe follows, and then the US session approaches, traders start doing math they really don't like. If they can't post collateral, they have to sell. There's no negotiation. There's no waiting for better prices. When they sell, price drops. And when price drops, margin requirements effectively rise again because the equity in those positions shrinks. That's the cascade. That's the spiral. And it feeds on itself until either enough selling exhausts or new capital steps in to stabilize things. But here's what makes this so dangerous. The selling accelerates as it moves. The first wave of liquidations triggers stops. Those stops trigger more margin pressure on other accounts. And suddenly, you've got a feedback loop where price isn't discovering value anymore. It's discovering who's running out of capital first. Now here's the part that should make you pay close attention. This selling has almost nothing to do with silver's long-term fundamentals. It's a liquidity event. Pure forced liquidation. And that's exactly why you saw silver fall straight through levels that everyone swore were strong support. Everyone said $85 is solid. Then it blew through 85. Everyone said $80 is the line. Then it hit the high 70s and kept going. Why? Because those support levels assume rational actors making rational decisions based on value. But when you're forced to sell, value doesn't matter. You sell at whatever price clears. It wasn't a vote of no confidence. It was a margin call. And yes, you're probably hearing claims right now that this was engineered. People are pointing to the timing of the margin hike, chatter around JP Morgan Chase positioning, even temporary disruptions tied to the London Metal Exchange and HSBC. Now let me show you what most people are missing here. Whether those claims are true or not, and I'm not saying they are or aren't, the price action would have looked almost identical anyway, because the mechanism itself creates the crash. You don't need a conspiracy when the mechanics are this brutal on their own. Margin hikes plus leverage plus thin liquidity equals violent moves. That's not manipulation. That's math. So let me give you the secondary layer that confirms this wasn't about fundamentals. Look at what happened with volatility. When you see implied volatility spike like it did, that's not investors reassessing the long-term case for silver. That's traders scrambling for hedges. That's option markets pricing in panic. And look at the trading volumes. They weren't orderly. They were chaotic, big blocks moving fast. That's liquidation signature, not strategic repositioning. And here's the kicker. Look at the correlation with other assets during the move. When silver was collapsing, you didn't see a broad flight to safety. You didn't see gold holding up perfectly or treasuries rallying hard. You saw dislocated mechanical selling. That tells you this wasn't macro reassessment. This was structural. Now combine those two pieces. You've got the primary driver, which is margin hikes forcing liquidation, and you've got the secondary confirmation, which is volatility signatures and volume patterns that scream forced selling. When both of those line up, you know exactly what you're dealing with. And that knowledge is power, because it tells you what to watch for next. It tells you when the risk is actually subsiding versus when it's just pausing before another leg down. This is the exact same playbook we've seen before. And if you zoom out, you see it so clearly it's almost eerie. In 2011, silver collapsed after margin hikes stacked up in rapid succession. They didn't just raise margins once, they raised them multiple times in a short window. And that following Monday after the initial crash, it wasn't calm. It was volatile, it was choppy, it was brutal. People thought the worst was over. It wasn't. You had sharp bounces that failed. You had attempts to stabilize that got sold into. It took time for the real bottom to form. Go look at the charts from May 2011 if you want to see how this plays out. Now fast forward to March 2020. Different asset class, same mechanics. Liquidity vanished across markets. Margins tightened. Forced selling cascaded. And you know what happened on the first bounce? It failed. The real bottom didn't come until selling pressure actually exhausted, and stabilization could hold for more than a few hours. Every single time this pattern shows up, the first rebound feels convincing. Traders see a 10% move off the lows and think, that's it, we're done, time to buy. And every single time it's unreliable. Until the forced selling genuinely stops. When you look at the pattern historically, Mondays after forced liquidations aren't about catching upside. They're about testing who's still trapped. They're about shaking out the last of the weak hands. And until that process completes, volatility stays elevated and bounces stay suspect. Let me give you one more example because I want this pattern locked in your mind. Go back to the oil market in 2020 when crude went negative. Remember that? Everyone freaked out. How can oil trade at negative prices? It doesn't make sense. Except it did. Because traders holding futures contracts with no storage and no ability to take physical delivery had to sell at any price. That's forced liquidation at its most extreme. The fundamentals of oil didn't change overnight. Supply and demand didn't suddenly invert. But the mechanics of who had to exit and when created a price that looked insane. Same principle here. Silver's fundamentals didn't evaporate. Industrial demand didn't vanish. But the mechanics of margin and leverage created a move that feels disconnected from reality. And if you understand that, you don't panic. You watch. You wait. You let the mechanics resolve before you make big decisions. That's the lesson from every historical precedent. The fundamentals eventually reassert, but the mechanics have to clear first. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just a narrative that fits neatly. Could this snap back hard and invalidate everything I just said? Of course. Markets love to humiliate certainty. Could we wake up tomorrow and silver's back at $110? Maybe. Is it probable based on historical patterns? No. But is it possible? Always. And about those manipulation claims, here's the thing. You don't need a villain for this to happen. Margin mechanics alone can do the damage, and even if there was intentional positioning or strategic timing by certain players, focusing only on that distracts you from what actually helps you make decisions. You can't control exchange policy. You can't control what JP Morgan or any other bank does with their book. You can control how you respond to volatility. You can control how much leverage you use. You can control whether you wait for confirmation instead of chasing the first bounce off a low. That's where your edge is, not in figuring out who's to blame, in figuring out how to navigate what's in front of you. So when you see people obsessing over whether this was manipulation, ask yourself this. Does that debate change your risk management? Does it change your position sizing? Does it change whether you should wait for stabilization? Probably not. Focus on what you can control. There are probably 3 types of people watching this right now. Let me talk to each of you directly, because I think you need to hear different things. First, you might be underwater. You're holding silver positions in the low 80s, and you're staring at your account, and you're wondering if you should panic. If that's you, breathe. You're not crazy. You're not alone. And you're not the only one who got caught in this. The key right now isn't prediction, it's survival. If leverage is stressing you, reduce exposure. I'm serious. Don't let pride or hope keep you in a position that's causing you actual mental or financial stress. And stop anchoring to last week's highs. Stop thinking about where silver was at $121. That price is gone. It doesn't matter anymore. What matters is where we are now, and where we're likely to go next based on actual conditions. If you can hold without leverage, if you're in physical and you believe in the long-term case, then this is noise. But if you're leveraged and you're feeling the pressure, protect yourself first. There's no shame in stepping aside to reassess. Second, you might be flat right now. You're watching from the sidelines and you're tempted to buy the dip. I get it. Silver down 30% feels like opportunity, and maybe it is. But ask yourself this honestly. Has forced selling actually stopped yet? If volatility is still elevated going into the US close today, if we're still seeing chaotic price action, if stabilization hasn't held for more than a few hours, then patience pays. I'm not saying don't ever buy. I'm saying don't rush. The best opportunities come after the chaos settles, not while it's still unfolding. Wait for confirmation. Wait for a day or two where price actually holds a range. Wait for volatility to compress. That's not being scared. That's being disciplined. Third, you might be longer term and relatively unfazed. Maybe you're stacking physical. Maybe you're holding core positions with no leverage, and you're not stressed about short-term moves. If that's you, your edge is time. And that's a real edge. But even then, scale matters. Even if you're not worried about the day-to-day, recognizing when forced selling is happening helps you decide whether to add now or wait. My guess is if you're in this category, you're probably fine just holding. But if you were planning to add anyway, waiting for this to stabilize probably gives you better entry. The universal principle here, regardless of which type you are, is simple. Confirmation beats conviction. Always. Conviction without confirmation is just stubbornness, and stubbornness gets expensive in markets like this. So here's where I stand personally. I'm not chasing the bounce, and I'm not declaring a bottom. I'm watching. Let me tell you what I'm personally watching right now. First, I'm watching the $80 to $82 zone, because that's where immediate support seems to be forming and where price is trying to stabilize as I record this. If we can hold above 80 for a full session without breaking lower, that would indicate the worst of the forced selling might be behind us. But if we break below 75 and hold there, that suggests another leg down is possible. Second, I'm watching the $70 to $75 area, because historically that's where deeper washouts tend to finish if liquidation continues. If we touch that range and bounce hard with volume, that could mark an actual capitulation low. But we're not there yet. Third, I'm monitoring behavior more than just price. Does volatility compress into the close, or does selling accelerate? Do we see stabilization or more panic? That behavior tells me whether this is resolving or whether there's more pain coming. Based on my analysis, this move was mechanical and structural, not fundamental. The fundamental picture for silver hasn't changed. Industrial demand is still there. Supply constraints are still real. The macro environment that drove silver higher in the first place didn't evaporate overnight. What changed was leverage and liquidity. And that's temporary. Now, temporary could mean days or weeks, but it's not permanent. If history rhymes and silver stabilizes after forced selling exhausts, the move that follows could be significant, because you'll have cleaned out weak hands, reset positioning, and created a base that's not built on leverage. But we're not there yet. We need to see the mechanics resolve first. Here's what I'm not doing. I'm not buying aggressively right now. I'm not selling in panic. I'm not making big decisions while the dust is still flying. I'm waiting for clarity. And clarity comes from watching how price behaves after the initial chaos, not during it. I'm not a financial advisor. This is not financial advice. I'm sharing my framework and my approach. You need to do your own research. You need to make decisions that fit your situation, your risk tolerance, your time horizon. What works for me might not work for you. But I will say this: if you made it this far, you're thinking critically. You're not just reacting. You're trying to understand. That mentality will serve you well whether this market goes up, down, or sideways from here. Because the real skill isn't predicting the next move. It's recognizing the pattern and responding intelligently. If this breakdown helped you see what's actually happening instead of just watching numbers move, do me a favor. Share this with someone who needs to see it. Hit subscribe if you want more analysis like this, where I break down mechanics instead of just giving opinions. And drop a comment. Tell me where you think this goes next. Are you watching from the sidelines? Are you holding? Are you worried, or are you calm? I read every comment, and your perspective helps me understand what's useful versus what's just noise. The goal here isn't to tell you what to do. The goal is to show you how to watch, how to interpret, how to recognize when a move is mechanical versus fundamental. Because once you see that distinction, you stop getting shaken out by moves that don't actually change the thesis. You stop panicking when markets do what markets do. And you start making decisions from a place of understanding instead of fear. Stay sharp out there. Think critically. Verify what you hear. Question narratives that sound too neat. And make your own decisions based on what you see, not what someone tells you to feel. This silver move is teaching anyone who's paying attention a masterclass in market mechanics. Don't waste the lesson.